Today we're going to walk through the intrinsic value calculation of Sezzle Incorporated, SEZL, step by step using a discounted cash flow model. But before we get into the numbers, let's first understand what this company actually does. What Sezzle does. Sezzle Incorporated is a financial technology company that operates in the buy now, pay later, or BNPL industry. Its platform allows consumers to purchase products today and split the payments into multiple installments over time, typically for interest-free payments. This model is especially popular in e-commerce because it helps shoppers manage cash flow while allowing merchants to increase conversion rates and average order size. Sezzle mainly partners with online merchants and retailers, integrating directly into checkout systems. The company earns revenue primarily through merchant fees, consumer convenience fees, and subscription services, such as Sezzle Premium. Over the past few years, Sezzle has also expanded its ecosystem by introducing a subscription model and consumer-focused financial tools, which has helped improve profitability and user engagement. Historical stock performance. Since its IPO in August 2023, Sezzle Incorporated SEZL has delivered an extremely strong performance. The stock has increased about 454.92% since its IPO, which is very impressive for a fintech company in such a competitive space. However, like many high-growth stocks, the ride has not been smooth. Recently, the stock has pulled back significantly from its 52-week high of $186.74. This type of volatility is common for smaller fintech companies, especially after large rallies. And sometimes, these pullbacks create opportunities if the underlying fundamentals remain strong. So the big question becomes, what is the intrinsic value of Sezzle stock? To answer that, we can use a discounted cash flow, or DCF model, which estimates the present value of all the future cash a business is expected to generate. Base case intrinsic value calculation. Using recent valuation models from March 2026, the intrinsic value of Sezzle is estimated to be about $110.24 per share. Let's walk through the steps behind this calculation. Step 1. Determine the base cash flow. The starting point of a DCF model is free cash flow. For fiscal year 2025, free cash flow, $207.2 million. Adjusted net income, $128.4 million. Free cash flow is important because it represents the actual cash the company generates after operating and capital expenses. Step 2. Project future growth. Next, we project how fast the company could grow over the next 5 years. For 2026, management expects 25% to 30% revenue growth. Adjusted net income of about $170 million. Because Sezzle is still a high-growth fintech company, analysts typically assume 20% to 30% annual growth during the first 5 years of the DCF model. Step 3. Apply a discount rate. Future cash flows are worth less than cash today, so we discount them back to present value. For Sezzle, a typical discount rate used in valuation models is between 6% and 10%, reflecting the cost of equity and market risk. Step 4. Calculate the terminal value. After the 5-year growth period, we assume the company eventually grows at a more stable long-term rate. For this model, we use a 4% terminal growth rate to estimate the value of the business beyond the initial projection period. Step 5. Calculate equity value per share. Finally, we add up the present value of the projected cash flows, the terminal value. Then we adjust for net cash or debt and divide by the total number of shares. For Sezzle, diluted shares outstanding, 35.71 million. Using these assumptions, the estimated intrinsic value comes out to about $110.24 per share. Key financial insights. Here are a few important takeaways from Sezzle's financial performance. First, valuation margin of safety. With the stock trading around $73.44 as of March 2026, an intrinsic value of $110.24 suggests the stock could be undervalued by roughly 33%, depending on the accuracy of the assumptions. Second, strong earnings growth. Management recently raised its 2026 adjusted EPS guidance to $4.70, representing about 31% year-over-year growth. Third, operating leverage is improving. In 2025, Sezzle achieved a net income margin of 29.6%, which is very strong for a fintech company. This improvement was driven in part by record user engagement, with about 918,000 monthly active subscribers on the platform. Conservative valuation scenario. Of course, valuation models depend heavily on growth assumptions. So, let's consider a more conservative scenario. If we assume a lower growth rate between 20% and 25%, use the midpoint of 22.5% growth, and apply a higher 10% discount rate to reflect additional fintech risk. Then the intrinsic value of Sezzle Incorporated SEZL drops to approximately $92.17 per share. Even under this more cautious model, the valuation still suggests the stock may have upside potential relative to its recent market price, although the margin of safety becomes smaller. Final thoughts. As always, intrinsic value calculations are based on assumptions, and real-world outcomes can differ significantly. But DCF models can be a useful tool to estimate what a business might be worth based on its future cash-generating potential. If you found this analysis helpful, please like the video and subscribe to the channel for more deep dives into stock valuations and investing strategies. Thanks for watching, and I'll see you in the next video.